Welcome to session 10, Corporate Risk Management. The outline of the session is given here: introduction, key steps in risk management, risk measurement, risk mitigation measures, risk transfer mechanisms, management of forex exposure, management of strategic and other risks, guidelines for risk management and behavioral aspects, risk management practices. We live in a VUCA world, volatile, uncertain, complex, and ambiguous. Thanks to rapid globalization, interdependence of financial markets, shifts in economic power, and pressure on natural resources, we are witnessing swings in currencies, raw material costs, equity prices, and climate change. In early 20th century, Frank Knight, an eminent American economist, wrote a seminal book titled Risk, Uncertainty, and Profit. In this book, he made an important distinction between risk and uncertainty. He defined risk as a situation where possible outcomes are known and probabilities can be assigned to these outcomes. Uncertainty, on the other hand, refers to a situation where possible outcomes are not known, let alone the probabilities associated with these outcomes. We seem to be moving toward a world of more and more uncertainty. The major forces creating uncertainty in the new economy are technology and the internet, increased worldwide competition, free trade and investment worldwide, complex financial instruments, notably derivatives, deregulation of key industries, changes in organization structures resulting from downsizing, re-engineering and mergers, higher expectations for goods and services, more and larger mergers. Business firms are exposed to a variety of risks: technological risks, economic risks, financial risks, performance risks, legal and regulatory risks, people risks, geophysical risks, and environmental risks. The thrust of our discussion will be mainly on financial risks. We will look at other risks as well. In 1960s, Franco Modigliani and Merton Miller advanced the value conservation principle. According to this principle, the value of a firm was not affected by its capital structure or dividend policy or risk management policy. The view was that what a firm can do in these areas, investors could replicate in the capital markets, so the firm need not do anything in these areas. In 1970s, when the Bretton Woods agreement was abandoned and OPEC oil crisis emerged, financial prices became extremely volatile, currency rates became volatile, commodity prices became volatile, inflation became volatile. This had a hugely detrimental effect on a number of corporates which were totally unprepared for such heightened volatility. The initial reaction of these corporates was to forecast these financial prices. Forecasters, however, in general fail because financial prices tend to behave in a somewhat random manner. In order to address the concerns of business firms, the financial services industry promoted derivative products such as forwards, futures, swaps, and options as a solution to the risk management needs of corporates. In 1980s, the academia also realized the importance of risk management and its contribution to value creation. It was recognized that the total risk of a firm mattered because if a firm was highly risky, it could cause adverse incentives for managers and diminish commitments of various stakeholders. Also, it could lead to higher tax payment overall over a period of time. The emergence of derivatives triggered the golden era of finance. 1990s saw heightened risk and highlighted the importance of systematic risk management. Many organizations now have a position called Chief Risk Officer, and progressive firms have enterprise risk management systems or integrated risk management systems. 2000 saw the global financial crisis, which many consider as a black swan. Nassim Taleb is a leading risk philosopher of our times. He wrote a fascinating book called The Black Swan. According to him, a black swan is a highly unlikely event which has a huge impact and for which a very plausible story is concocted after the event has occurred. Even the COVID crisis of 2020 is considered as a major black swan. Financial innovations accelerated since 1990s. The motive force behind innovations like options, swaps, futures, and their innumerable permutations and combinations came from demand and supply side. On the demand side, floating exchange rates led to exchange rate volatility. Likewise, interest rates became highly volatile in 1980s. So corporates looked for products which helped them in mitigating risk. On the supply side, as traditional sources of income for banks such as interest, commissions, fees, and so on were subjected to a squeeze, they started offering complex, innovative products. In the wake of these developments, the risk management perspective in progressive companies is shifting from a fragmented, ad hoc, and narrow approach to an integrated, continuous, and broad approach referred to as integrated or corporate or enterprise risk management. The key steps involved in systematic approach to risk management are 1. Identify risks, 2. Measure risks, 3. Integrate risks, 4. Develop a risk response strategy, 5. Institute risk infrastructure. Identify risks. For example, TCS has recognized risks as follows: 1. Strategic, 2. Operational, 3. Financial, 4. Compliance related. In an article published in CFO magazine, Scott Lange, head of Microsoft Risk, identified 12 major sources of risk: business partners, competition, customers, distribution, financial, operations, people, political, regulatory and legislative, reputation, strategic, and technological. Lange's goal for Microsoft is to have risk management permeate the thinking of all managers and employees of Microsoft and become an integral part of their job. In many ways, it is similar to the quality movement of the 1980s and 1990s, which sought to take the responsibility for quality out of a separate quality control department and make all managers and employees accountable for quality. After identifying risk, the next step is to measure risk. At its simplest, measurement involves simply ranking various risks. At the next level, it involves imputing a monetary value to these risks. At a still higher level, it entails assigning probabilities to them as well. Integrate risks. Ideally, a company should integrate risks and adopt an enterprise-wide approach to risk management. Many companies, however, continue to manage risks in a piecemeal manner. This is because professions are generally organized around a single skill set. Develop a risk response strategy. A company can choose to mitigate risk, transfer risk, or accept risk. A company's risk appetite or that of its shareholders determines its risk response strategy. A company can mitigate its risk by making changes in its operations or its financial structure. A company can transfer risk through following means: insurance, forwards or futures, swaps, and options. Institute Risk Management Framework. Given the importance of risk management, firms are now articulating in great detail their risk management framework. This is the risk management framework of Infosys as drawn from one of its annual reports. In this framework, there are three elements: risk categories, risk governance structure, and key risk management processes. Risk categories spelled out as strategy, industry, counterparty, resources, operations, regulations, and compliance. Key risk management processes are risk identification and assessment, risk measurement, mitigation, monitoring, risk reporting and disclosure, integration with strategy and business plans. Risk governance structure indicates the people involved in risk management. It starts with the Infosian unit heads, Office of Risk Management, Risk Council, Risk Management Committee, Board of Directors. The two most important measures of risk are value at risk or VAR and cash flow at risk or CFAR. Value at risk reflects a limit on the loss of value of a portfolio on account of normal market movements which will be exceeded only by a small pre-specified probability. Thus, if VAR is rupees 100 million or whatever with a confidence level of 95%, it means that there is only a 5% probability the loss in portfolio will exceed rupees 100 million. The z quantile of a distribution is the probability that the random variable will be below that number is z%, and the probability that the random variable will be above that number is 100 minus z%. While z can be 1, 2, 5 or any other number, we will use z% as 5%. If the return on a portfolio is normally distributed, VAR can be easily computed. If X is a normally distributed random variable, U, which is defined as X minus expected value of X divided by standard deviation of X, follows a standard normal distribution. This means expected value is 0 and standard deviation is 1. The VAR at a confidence level of 95% represents the limit on loss that will be exceeded only 5% of the times at the end of a given measurement period. As we have assumed, X is normally distributed, hence the fifth quantile of the distribution of X can be obtained from the fifth quantile of U, and the fifth quantile of U is minus 1.65, which means for a standard normal distribution, probability of values following below minus 1.65 is 5%. Hence, the fifth quantile of X is minus 1.65 times sigma X plus expected value of X. To illustrate, suppose a bank has a portfolio of traded assets which have an expected return of 0.2% and a standard deviation of 6% on a weekly basis. The fifth quantile of the return distribution is minus 1.65 times the standard deviation plus expected return, which is 0.2%. This is minus 9.7%. For VAR, we consider the absolute value of the fifth quantile or 9.7%. Hence, if the bank's portfolio is worth rupees 100 billion, VAR is 9.7% of rupees 100 million or rupees 9.7 billion. This means the probability of loss exceeding 9.7 billion is only 5%. To sum up our discussion, VAR reflects the limit on the loss of value of a portfolio which will be exceeded only with a small pre-specified probability. The three steps involved in calculating VAR are: 1. Define the time period, define the confidence interval, calculate VAR. In our example, we have used a time period or measurement period of 1 week. We have defined the confidence interval as 95%. The expected return per week is 0.2%. The standard deviation of return per week is 6%. So the fifth quantile of return distribution is minus 1.65 multiplied by 6%, which is standard deviation, plus 0.2%, which is expected return per week. This works out to minus 9.7%. We work with an absolute figure of 9.7%. If the portfolio has a value of 100 billion, limit on loss is 9.7% of 100 million, which is rupees 9.7 billion, which means on a weekly basis the loss is not likely to exceed 9.7 billion with a probability of more than 5%. Though widely used, VAR suffers from several limitations. 1. It requires large amounts of historical data to assess expected value and standard deviation. 2. It reflects the level of loss that will be exceeded with X% probability, but not the largest loss that can occur. Companies use a number of operational measures for mitigating risk. The important ones are listed here. Invest in stages, improve information, shorten time to market, follow a suitable pricing strategy, develop contingency plans, make long-term arrangements, enter into strategic alliance, build greater flexibility in operations, outsource, diversify. Risk can be mitigated by making following changes in financial structure, reducing debt equity ratio, carrying surplus liquidity. Principle of comparative advantage. In deciding whether a firm should retain or transfer risk, it should follow the principle of comparative advantage. A company may have no special ability in forecasting market variables such as exchange rates, interest rates, or commodity prices, so it would do well to transfer these risks. On the other hand, it is likely to have a comparative advantage in bearing firm-specific business risk. For example, an R&D intensive pharmaceutical company like Amgen may have comparative advantage in bearing R&D risks. The principle of comparative advantage reinforces the notion that companies are in the business to take strategic and business risks. It makes sense for companies to reduce non-core exposures so that they can take more strategic business risks and exploit the opportunities in their core business. The most common risk transfer mechanisms are forwards, futures, swaps, and options. Forward contracts are perhaps the oldest and simplest tools for managing financial risk. A forward contract represents an agreement between two parties to exchange an asset for cash at a predetermined future date called the settlement date for a price that is specified today. For example, if you agree on January 1 to buy 100 bales of cotton on July 1 at a price of rupees 800 per bale from a cotton dealer, you have entered into a forward contract with a cotton dealer. As per this contract, on July 1, you will have to pay rupees 80,000 and the cotton dealer will have to supply 100 bales. In forward contracts, it is common to think in terms of a short position and a long position. A short position commits the seller to deliver an item at a contracted price on maturity. A long position commits the buyer to purchase an item at a contracted price on maturity. The forward buyer is obliged to purchase the underlying instrument at the contract price or enter into an offsetting transaction. Let us look at the payoff profiles of a forward contract. Mr. X agrees to buy from Mr. Y some share for rupees 100 to be delivered 3 months later. This is a forward contract between X and Y. X is the forward buyer and Y is the forward seller. The contract price is C. The payoff profile for the forward buyer, that is Mr. X, is shown by this line. The contract price is indicated by the intersection here. The contract price is 100 rupees. If the price of the share happens to be 120 3 months later, then the gain of X is 20. If the price happens to be 80, the loss of X is 20. As far as Y, the forward seller, is concerned, the payoff profile is shown in this graph. You find that this profile is the mirror image of this profile. When X gains, Y loses. When X loses, Y gains. To understand how a forward contract may be used for hedging, let us look at the case of a refinery. The inherent risk profile of the refinery with respect to the price of crude oil is shown here. If the price of crude oil goes up, the refinery loses. If the price of crude oil falls, the refinery gains. In order to hedge this risk, the refinery enters into a forward contract to buy at a contract price. The payoff of the forward contract, as we have seen, is like this. This payoff offsets the inherent risk profile. So when the refinery buys a forward contract, it ensures that the inherent risk profile is countered and its final payoff is given by this straight line. There are several differences between forward contracts and futures contracts. Forward contracts are traded over the counter, futures contracts are traded on an organized exchange. There is no secondary market for forward contracts, there is an active secondary market for futures contracts. Forward contracts are contracts negotiated bilaterally between the buyer and the seller, and the terms are customized. Futures contracts are standardized contracts in terms of quantity, date, and delivery conditions. Most forward contracts end with physical delivery. Normally, futures contracts are offset by a counter transaction. There is no delivery. Forward contracts entail counterparty risk. There is no counterparty risk as far as futures contracts are concerned because a clearing corporation interposes itself between the buyer and the seller. No collateral is usually required in a forward contract. In a futures contract, collateral has to be posted with the exchange. Further, the contract is marked to the market on a daily basis. Participation is limited to a small number of large traders as far as forward contracts are concerned. A large number of participants participate in futures contracts. Marking to market, a futures contract may be likened to a series of forward contracts in which each day, previous day's contract is settled and that day's contract is written. To understand how marking to market works, let us look at an example. A purchases a futures contract on January 1 to buy 1 barrel of oil for $48 to be delivered on 31st January. This is the futures price of that 31st January contract. So he agrees to buy at $48. On January 2, the same contract is priced lower at $47, which means A has lost $1. He pays that $1 to the exchange. Essentially, he closes the previous contract and enters into a new contract under which he agrees to buy 1 barrel of oil to be delivered on January 31 for $47. On January 3, the same contract is priced higher at $49, which means A gains. What is agreed to buy at 47 is now selling at 49. So he gets a difference of $2 from the exchange, which means the previous contract is closed and he enters into a new contract to buy at $49. There is no change in the price of the futures contract for the rest of the month. So on January 31, A finally pays $49 and gets 1 barrel of oil. If you look at this arrangement, you find that it has three important features. Both the buyer and the seller of a future contract have to post a margin with the exchange. There is marking to market on a daily basis for the buyer as well as the seller. The exchange interposes itself between the buyer and the seller, so there is no counterparty risk whatsoever. Just the way a forward contract eliminates price risk, a futures contract eliminates price risk. If this is the inherent risk profile of a company, it can enter into a futures contract which is a payoff like this. So the inherent risk profile is countered by the payoff of the futures contract, and the firm is protected against price fluctuations. Futures contracts have a tremendous appeal because of certain advantages. One, there is no need for an initial cash flow except the margin. Two, it is easy to go short as well as long. Three, it is easy to close a futures contract by an offsetting trade. Four, a wide range of futures contracts is available. What is the relationship between spot and futures prices? We'll look at financial instruments first and then we'll examine commodities. In the case of a financial instrument, the futures price is payable at some point of time in future. On the left hand side, I have the discounted value of the futures price. So this represents the present value of the futures contract. On the right hand side, I have the present value under the spot contract. Under the spot contract, spot price has to be paid today. However, when you buy something in the spot market, you enjoy interest or dividend on the instrument. So the present value of interest or dividend is deducted from the current spot price to get the present value under the spot contract. This is the present value under the futures contract. This is the present value under the spot contract. If the two diverge, arbitrageurs will step in and eliminate the disparity. What is the relationship between futures price and spot price for commodities? On the left hand side is the present value of the futures price. On the right hand side is the present value of the spot contract. When you enter into a spot contract for a commodity, you pay the spot price. Since you get the commodity, you have to store the commodity. So there is a cost associated with the storage of the commodity. The present value of the storage cost has to be added to the spot price. Of course, when you buy something in the spot market, you have the convenience yield available to you. If you buy aluminum in the spot market, you can use aluminum for your production purposes. Such convenience is not available in a futures contract. If you buy a futures contract for aluminum, you cannot use the contract for your production purposes. So on the right hand side, we have the present value of the spot contract as a sum of three things: spot price plus present value of storage cost minus present value of convenience yield. Let us look at a solved problem. The stock index is currently at 1400 and 1-year stock index futures is trading at 1500. The risk-free annual rate is 11%. What is the average annual dividend yield on the stocks in the index? We set up this equation. In this equation, on the left-hand side is the present value of the futures contract. On the right-hand side is the present value of the spot contract. In this equation, futures price is known, risk-free rate is known, spot price is known, dividend yield is not known, interest rate, risk-free interest rate is known. We solve this equation for dividend yield and find that it is 0.038 or 3.8%. Here is a solved problem relating to commodity futures. The following information is available for steel scrap. Spot price rupees 4,500 per ton. Futures price rupees 5,000 for 1-year contract. Risk-free rate of interest 12%. Present value storage cost rupees 200. What is the present value of convenience yield of steel scrap? We set up an equation like this. On the left hand side is the present value of the futures price. On the right hand side is spot price plus present value of storage cost minus present value of convenience yield. In this equation, futures price is rupees 5,000, risk-free rate of interest is 12%, spot price is rupees 4,500, present value of storage cost is rupees 200. Solving this equation for present value of convenience yield, we find that the present value of convenience yield is rupees 235.7 per ton. A forward rate agreement or an FRA is a forward contract for a short-term loan at a rate of interest that is specified today. For example, a 3 to 9 FRA is a 3 months forward contract on a 6-month loan. The notional amount and the FRA rate have to be specified. Let us assume that the notional amount is 100 million USD and the FRA rate is 4.2%. After 3 months, the reference rate would be known and the FRA is cash settled. Suppose the reference rate after 3 months turns out to be 4.4%. In this case, the buyer of the FRA will benefit because the buyer has contracted to take a loan at a rate of 4.2%, but the reference rate turns out to be 4.4%. So the buyer will get the difference. The buyer is entitled to receive a payment equal to notional amount multiplied by the difference between the reference rate, which is 4.4%, and FRA rate, which is 4.2%, multiplied by number of days during that 6-month period, divided by basis. The basis is either 360 days or 365 days depending on the currency in which the FRA has been done. This benefit that the buyer is entitled to is receivable at the end of the period, so it has to be discounted for that 6-month period. In our example, the notional amount is 100 million USD, reference rate is 4.4%, FRA rate is 4.2%, number of days is 184, basis is 360. This is the amount receivable by the buyer of the FRA, but it will be receivable after 6 months. So this has to be discounted for a 6-month period. The numerator of this ratio shows the amount the buyer of the FRA has to receive. Since this amount is receivable 184 days later, it is discounted for 184 days at the reference rate and paid to the buyer. A swap contract is an agreement between two parties to exchange one set of cash flows for another. In essence, it is a portfolio of forward contracts. While a forward contract involves one exchange at a specific future date, a swap contract entails multiple exchanges over a period of time. There are three kinds of commonly used swaps: principal-only swap, interest rate swap, and currency swap. Principal-only swap. Under a principal-only swap, there is an exchange of principal between two currencies. IRFC, for example, entered into a principal-only swap with banks. Under this swap, it replaced USD 80 million euro currency borrowing with Indian national rupee. Banks would pay USD 80 million to IRFC in 5 equal installments of USD 16 million each. IRFC in turn would pay rupee equivalent at a predetermined conversion rate. An interest rate swap is a transaction involving exchange of one stream of interest obligations for another. Typically, it results in an exchange of fixed rate interest payments for floating rate interest payments. Occasionally, it involves an exchange of one stream of floating rate interest payments for another. The principal features of an interest rate swap are: 1. It effectively translates a floating rate borrowing into a fixed rate borrowing and vice versa. The net interest differential is paid or received, as the case may be. 2. There is no exchange of principal repayment obligations. 3. It is structured as a separate contract distinct from the underlying loan agreement. 4. It is applicable to new as well as existing borrowing. 5. It is treated as an off-the-balance sheet transaction. To understand how an interest rate swap works, let us look at an example. Firm A can raise a loan of 100 million US dollars in the floating rate market at LIBOR. It can raise a loan of 7 years maturity at LIBOR, and it expects the LIBOR to vary in this manner over a 7-year period. It is, however, interested in converting its LIBOR obligation into a fixed rate obligation, and a swap bank quotes a fixed rate of 7.5%. When the swap is done, the swap bank will pay the firm the LIBOR floating rate. In turn, the firm will pay the swap bank a fixed rate of 7.5%. So the net cash flow from swap would be as shown here. In year 1, when LIBOR floating is 6.5% and a loan of 100 million entails an interest burden of 6.5 million, the firm receives 6.5 million from the swap bank. In turn, it pays swap bank 7.5 million. So the net cash flow for the firm is minus 1 million. In year 2, when the LIBOR floating is 7%, the firm has to pay a net amount of 0.5 million. In year 3, when the LIBOR floating happens to be 7.5%, there is no exchange whatsoever. In year 4, when the LIBOR floating happens to be 8%, the firm receives 0.5. So these are the net cash flows to the firm from the swap, and the net payments to the firm on account of that loan are shown here. Generally, when a firm wants to convert a floating rate loan into a fixed rate loan or vice versa, it approaches a swap bank. The swap bank in turn finds a counterparty so that the interests of the two parties are matched, and the swap bank serves as an intermediary. Let us look at an example to understand how this works. Amit Limited is interested in fixed rate borrowing of 50 million USD. Sumit Limited is interested in a floating rate borrowing of 50 million USD. In the fixed rate loan market, Amit Limited can raise at 7%. In the floating rate loan market, Amit Limited can raise at LIBOR plus 50 basis point. Sumit Limited can raise money in the fixed rate market at 5%, in the floating rate loan market at LIBOR. We find that Sumit Limited has an absolute advantage in both the markets. In the fixed rate market, it can borrow at 5%, whereas Amit Limited has to pay 7%. In the floating rate loan market, it can borrow at LIBOR, and Amit Limited has to pay LIBOR plus 50 basis point. However, Amit Limited has a comparative advantage in the floating rate loan market. In the floating rate loan market, it has to pay only 50 basis point more. In the fixed rate loan market, it has to pay 2% more. So Amit Limited is well advised to raise money in the floating rate loan market where it has a comparative advantage and convert that into a fixed rate loan. Sumit Limited has an advantage in the fixed rate market, so it should raise money in the fixed rate market and swap it into a floating rate loan. This is how it will work when the swap bank charges 50 basis point for intermediation. Amit Limited raises $50 million in the floating rate loan market at LIBOR plus 50 basis point. It receives LIBOR from the swap bank. It pays 6% fixed rate to the swap bank. As a result, its liability is now only 6.5% fixed rate. You can see why. It pays 6% here, it receives LIBOR here, it pays LIBOR plus 50 basis points, so its total burden is 6.5%. If it were to raise money directly in the fixed rate loan market, it will have to pay 7%. Since it seeks a fixed rate loan, it is advantageous for it to first borrow in the floating rate loan market and do the swap. Let us look at the picture for Sumit Limited. Sumit Limited has a comparative advantage in the fixed rate loan market, so it raises money in the fixed rate loan market at 5%. It pays LIBOR to the swap bank. It receives a fixed rate of 5.5% from the swap bank. So as far as Sumit Limited is concerned, its effective cost is now LIBOR minus 50 basis point. It pays LIBOR, it receives 5.5% fixed rate, it pays 5% fixed rate. So its net cost is LIBOR minus 50 basis point. If it were to approach the floating rate loan market directly, it will have to pay LIBOR. By doing this swap, it has reduced its cost by 50 basis point. Amit Limited also has reduced its cost by 50 basis point, and the intermediary also gets 50 basis point. A default swap is a credit derivative which protects against default risk. For example, Company A agrees to pay a fixed amount annually to Company Q as long as X, a debtor of Company B, does not default. In return, Company Q promises to compensate Company P should X default. Essentially, company P is seeking insurance against a possible default by its debtor X, and company Q provides that insurance. In order to provide insurance, company Q collects a premium annually from company P. In a currency swap, both the principal and interest in one currency are swapped for principal and interest in another currency. On maturity, the principal amounts are swapped back. Thus, a currency swap involves 1. An exchange of principal amounts today, 2. An exchange of interest payments during the currency of the loans, 3. A re-exchange of principal amounts at the time of maturity. Let us look at an example to understand how a currency swap works. Hi-Tech Limited is an American company very well known in the US capital market. Hi-Tech Limited wants to set up an operation in UK for which it requires 100 million pounds. Hi-Tech is not known well in the UK capital market, so Hi-Tech raises $120 million in the US capital market at an interest rate of 5%, which are equivalent to 100 million pounds. So initially, this is the exchange between Hi-Tech Limited and the swap bank. Hi-Tech Limited gives swap bank $120 million, which it would have raised in the US capital market. In turn, Hi-Tech Limited gets 100 million pounds, which it uses for its UK operations. During the currency of the loan, Hi-Tech Limited receives $6 million from the swap bank, which it uses to pay interest on its US dollar borrowing. Hi-Tech Limited in turn pays 4 million pounds to the swap bank because swap bank would have raised 100 million pounds at an interest rate of 4%. At the time of maturity, Hi-Tech Limited would receive $120 million from the swap bank, which it uses to repay its principal obligation on the US dollar loan. In turn, Hi-Tech Limited pays 100 million pounds to the swap bank. We looked at forwards, futures, and swaps. Let us now turn our attention to options, which many regard as the most important financial innovation of the last 4 to 5 decades. Our discussion is organized along these lines. We'll look at the distinction between forwards and options. We'll understand what call options are, what put options are, and how options can be used for risk management. So far we looked at forward contracts or futures contracts or swap contracts, which are essentially similar in nature. Now we look at how an option contract differs from a forward contract. There are two key differences between a forward contract and an option contract. In a forward contract, both parties are obligated to transact in future. In an option contract, the transaction occurs only if the buyer or holder of the option chooses to exercise it. When a forward contract is created, no money changes hand. On the other hand, when an option contract is created, the buyer of the option contract pays option premium to the seller of the option. In a way, the seller of the option is provided some kind of insurance to the buyer of the option, and the buyer pays an option premium which is akin to insurance premium. The buyer of an option is like a person who buys an insurance policy. The seller of an option is like an insurance company. The buyer pays premium, the seller receives premium. Let us look at what lies in store for the buyer and the seller. Rights and obligations. Buyers have rights but no obligations. Sellers have only obligations, no rights. Call option. A call option is a right to buy or to go long as far as the buyer is concerned. A call option entails an obligation to sell or go short on exercise as far as the seller is concerned. A put option is a right to sell or to go short as far as the buyer is concerned. A put option implies an obligation to buy or go long on exercise as far as the seller is concerned. Premium, the buyer pays the premium, the seller receives the premium. Exercise, Exercise is at the discretion of the buyer. Seller has no influence over exercise. Maximum possible loss as far as the buyer is concerned is a cost of premium. As far as the seller is concerned, it is unlimited. Maximum possible gain as far as the buyer is concerned, it is unlimited profit. As far as the seller is concerned, it is the price of premium. Closing position, if the option contract is exchange traded, the buyer can exercise the option or the buyer can offset by selling the option in the market, or the buyer can let the option expire worthless. As far as the seller is concerned, the seller can assign the option to another party or offset it by buying back option in the market and keep the full premium if the option expires. The payoff profiles for call and put options are shown in these diagrams. Here is the payoff profile for buying a call option. Suppose someone buys a call option on the equity shares of Reliance Industries Limited at an exercise price of 2,200, which is indicated by this point. If the price goes up to 2,400, the buyer of the call option enjoys a gain of 200. If the price falls below 2,200, the buyer of the call option will not exercise the option, so it is worthless. So as far as the buyer of the call option is concerned, the payoff profile is like this. This indicates the increase in value. This indicates increase in the price of the underlying stock. If the price of the underlying stock goes up, the value to the buyer of the call option goes up. If the price of the underlying stock falls, the value to the buyer of the call option is nil. What is the payoff profile for the seller of a call option? The payoff profile for the seller of the call option obviously would be the mirror image of the payoff profile for the buyer of the call option. What about a put option? As far as a put option is concerned, it gives the buyer of a put option the right to sell a certain asset at a certain price in future. Suppose you buy a put option on the shares of Reliance, giving you the right to sell shares of Reliance at 2,200 rupees. If the price falls to 2,000, you gain 200 rupees because you can sell at 2,200 what is available in the market at 2,000. So as a buyer of a put option, you gain in value if the price falls below the exercise price. On the other hand, if the price remains at the exercise price or rises above the exercise price, you will let your put option expire worthless, so it has no value whatsoever. As far as the seller of a put option is concerned, his payoff would be the mirror image of the payoff for the buyer of a put option. Look at these diagrams carefully to understand the payoff profiles for call and put options for buyers and sellers. So far we have looked at the payoff profiles. Now let us look at the profit profile. To get the profit profile, we have to incorporate the call premium. We found that the payoff profile for the buyer of a call option is given by this line. When you buy a call option, you have to pay a premium. Suppose you buy the call option which gives the right to buy shares of Reliance Industries Limited at 2,200, and you pay a premium of 200 rupees. So you incur a cost which is in the nature of call premium. So your profit would be payoff from the call option less the call premium. As long as the stock price remains at 2,200 or less than 2,200, you incur a cost which is indicated by this line. which is a loss to you. When the price starts moving upward, your gain increases, and the difference between the payoff curve and the profit curve is the call premium. Suppose the unhedged risk profile of a firm is like this. To hedge itself, the firm can buy put options. Put options have a payoff like this, as we have learned. If we combine the unhedged risk profile with the put option payoff, we get the hedge profile, which is like this, which means the firm enjoys the upside and has protection against the downside. Of course, to enjoy these benefits, the firm has to pay the premium on put options. To understand how options may be used for mitigating risk, let us look at an example. Magnum Refineries is concerned about potential increases in the price of heavy crude oil, its major input. To protect itself against risk, Magnum Refineries buys 6-month options to purchase 10,000 barrels of crude oil at an exercise price of $50 per barrel. It pays a premium of $10,000 to buy the call option. Let us look at the payoff from this option contract for different levels of oil price 6 months hence. If the oil price 6 months hence is $48, the option is worthless because no one would exercise an option to buy at $50 when the prevailing price is $48. If the price is $50 per barrel, the option again is worthless. However, if the price is $52, the payoff from the call option is $20,000 because the option contract entitles Magnum Refineries to buy at $50 what is then available at $52. The net payments are $480,000, $500,000, $500,000. These are the net payments Magnum Refineries would have to make 6 months hence for buying 10,000 barrels of crude oil. Magnum protects itself against increase in oil price beyond $50 per barrel while benefiting from oil price decreases. Of course, this asymmetry comes at a price as Magnum has to pay an option premium of $10,000. Using options to manage financial price risk, a firm may use options instead of using forwards, futures, or swaps for several reasons. Choice of markets, options can be purchased either on an exchange or over the counter. Maximum loss, the most that can be lost is the price paid for the option. Flexibility, options are highly flexible tools for managing risk. There are two key differences between a futures contract and options contract. In a futures contract, there is no upfront cost, however, there is an opportunity cost. For example, you sell 100 grams of gold in a futures contract for rupees 5 lakhs and the contract maturity is 6 months. After 6 months, if the spot price of gold turns out to be rupees 6 lakhs, then you have lost the opportunity of benefiting from price appreciation. In an options contract, there is an upfront cost. You have to pay the options premium. However, there is no opportunity cost. Whichever way the price moves, you stand to gain. In a futures contract, there is a mark to market. In an options contract, there is no mark to market. Hedging with insurance. Most business firms buy insurance against a variety of risks. The risk of plant destruction and fire, the risk of liabilities arising from legal suits, the risk of losing key persons, and so on. Advantages offered by an insurance company. 1. It prices risk reasonably accurately. Over a period of time, it has considerable experience in pricing risk reasonably accurately. 2. It provides low-cost administration service because it handles large volumes of business. It is able to reduce its cost of administration. 3. It has expertise in suggesting risk reduction measures. 4. It is able to pool and manage risk much better. Disadvantages suffered by an insurance company. 1. It incurs administrative costs which are passed on to the client. 2. It faces the problem of adverse selection. Candidates who are likely to be exposed to greater risk may seek insurance. Candidates who are less exposed to risk may avoid insurance, or the insurance company may end up having clients who have a more than normal exposure to risk. 3. It faces the problem of moral hazard. After someone has taken an insurance cover, he or she is likely to behave somewhat negligently. For example, if you have taken a comprehensive automobile insurance policy, you are likely to drive somewhat recklessly. All these costs are borne by the insurance company, which are passed on to their clients because the insurance company would like to remain in a viable business. Risk management products have developed to cope with increased volatility in exchange rates, interest rates, and commodity prices. This exhibit shows the relationship between volatility and evolution of risk management tools. Exchange rate volatility has led to a number of risk management tools. Interest rate volatility has triggered a number of risk management tools. Petroleum price volatility has triggered a number of risk management tools. Metal price volatility has stimulated a number of risk management tools. The range of risk management products is virtually endless. The volume of exchange-traded listed options and futures contracts has increased dramatically in the last 4 decades or so. This is shown in this graph. It seems that there is a financial Moore's law at work. Management of forex exposure is an important aspect of financial management. We'll discuss the types of exposure, steps involved in managing currency exposure, mix examples, some good practices in managing transaction exposure, and managing operating exposure. There are three kinds of foreign exchange exposures: transaction exposure, translation exposure, and operating exposure. Transaction exposure: when a firm has a payable or receivable denominated in a foreign currency, a change in the exchange rate will alter the amount of local currency received or paid. Such a risk or exposure is referred to as transaction exposure. For example, if an Indian exporter has a receivable of $100,000 due 3 months hence, and if in the meanwhile the dollar depreciates relative to the rupee, a cash loss occurs. Conversely, if the dollar appreciates relative to the rupee, a cash gain occurs. In the case of a payable, the outcome is of an opposite kind. A depreciation of the dollar relative to the rupee results in a gain, whereas an appreciation of the dollar relative to the rupee results in a loss. Translation exposure, also called accounting exposure, stems from the need to convert the financial statements of foreign operations from foreign currencies to domestic currency for purpose of reporting and consolidation. If there is a change in exchange rate since the previous reporting period, the translation or restatement of foreign currency denominated assets, liabilities, revenues, and expenses will result in foreign exchange gains or losses. Translation gains or losses do not involve cash flows, as they are purely paper gains or losses, except when they have some tax implications. Operating exposure is also called economic exposure. Operating exposure, like transaction exposure, involves an actual or potential gain or loss. While the former is specific to a transaction, the latter, much broader in nature, relates to an entire investment. The essence of operating exposure is that exchange rate changes significantly alter the cost of a firm's inputs and the prices of its output, and thereby influence its competitive position substantially. An example may be given to explain the concept of operating exposure. Volkswagen had a highly successful export market for its Beetle model in the US before 1970. With the breakdown of the Bretton Woods system of fixed exchange rates, the Deutschmark appreciated significantly against the dollar. This created problems for Volkswagen as its expenses were mainly in Deutschmark but its revenues in dollars. However, in a highly price sensitive US market, such an action caused a sharp decrease in sales volume from 600,000 vehicles in 1968 to 200,000 in 1976. Incidentally, Volkswagen's 1973 losses were the highest as of that year suffered by any company anywhere in the world. There are three broad steps involved in managing currency exposure. Step 1, identify the exposure. Direct exposures arise on account of imports, exports, and borrowings in foreign currencies. Indirect exposures arise on account of import parity pricing. Even though a firm may not be exporting or importing, the prices of the goods that it produces and sells in the domestic market will be influenced by the prices of similar goods in international markets. For example, a steel company in India which produces only for the domestic market is exposed to the risk of fluctuation of steel price internationally. Step 2, choose scenarios for the rupee. A common practice is to look at quarterly adverse variation of 10%. Step 3, choose the hedging strategy. A firm may have to decide how much of its exposure should it hedge. Merck has a fairly well thought through foreign exchange risk management program. Merck is a leading multinational pharmaceutical company headquartered in the US. It sells in more than 10 countries. Its overseas sales account for more than 50% and they are made in local currencies. Merck spends substantial sums on R&D, which is critical for its competitive strength. The major concern for Merck is to ensure that it has funds for its R&D program. So the thrust of its risk management program is to ensure that Merck has adequate funds for R&D. The steps involved in the risk management program of Merck are as follows. 1. Project exchange rate volatility. Project the probability of adverse exchange rate movement. 2. Assess the impact of exchange rate volatility on its 5-year strategic plan, its ability to meet R&D needs and dividend payment needs. 3. Decide on whether to hedge a certain exposure or not. 4. Select appropriate financial instruments. Merck relies largely on plain vanilla options. 5. Construct a hedging program. Merck has a multi-year hedging program. Merck does partial hedging, not total hedging. Merck does not rely on far out the money options. What is a far out of the money option? A far out of the money option is an option which is going to be valuable only if there is a wide movement in price. Suppose I buy a call option on Reliance which gives me the right to buy the shares of Reliance as 2,600 rupees, but the current market price of Reliance is only 2,000. So that call option would be deemed as a far out of the money call option because Reliance price will have to move beyond 2,600 for that option to be valuable. As Judy Lubent of Merck said, we shed risk to take more risk. Essentially, she is saying that they shed or transfer exchange rate risk so that they can take more business risk and R&D risk. Here are some good practices for managing forex exposure. 1. Use simple derivative products. They are called as plain vanilla products. Avoid complex and exotic products. 2. Identify contingent exposure when a bid is made and buy out the money option contracts. 3. Recognize contractual exposure the moment a contract is signed, even though there may be no letter of credit, even though goods may not have been shipped, even though invoices may not have been raised. 4. Manage net exposures and decide how much of the net exposure would the company like to hedge. 100%, 75%, 50%, 0%, or some other percent. 5. Specify maximum portfolio loss in a year on account of open positions and divide it into quarterly limits. 6. Even Though an exposure may be left open, it is advisable to apply stop loss in relation to a benchmark rate, which is usually the forward rate. 7. Maintain EEFC or exchange earnest foreign currency in each major currency of the company's receipts and payments. The objective is not to earn exchange profit but match receipts and payments and reduce transaction costs. A commodity spread is used by a firm which buys raw material from abroad and sells final products in overseas market. The firm buys commodity futures and sells product futures. It locks in the operating margin. For example, crack spread is the difference between the price of crude oil and the price of refined oil products. The most popular risk management tools in India are forward, swaps, options, and futures. Companies seem to have a strong preference for forwards and swaps over futures and options, and this preference is because they would like to do risk hedging through the banking system rather than the capital market. Perhaps banks are able to customize a risk management solution to the specific needs of the company much better than the capital market. Most companies use derivatives routinely for managing foreign exchange risk. Reliance Industries Limited relies heavily on forward contracts, option contracts, and currency swaps because its key input crude oil is purchased in US dollars and the bulk of its output exported. Further, it has significant position by way of borrowings in US dollars. TCS uses heavily option contracts for hedging its US dollar denominated receivables. Options make sense when the exchange rate is very volatile. Maruti Suzuki uses mainly forward Indian national rupee, Japanese yen contracts because of its obligations for paying royalties and a significant amount of imports from Japan in yen. There are three broad policies with respect to risk management: 100% hedging, 0% hedging, selective hedging, and trading. Under 100% hedging, all exposures are hedged. Under 0% hedging, no exposure is hedged. Under selective hedging, some exposures are hedged, some are unhedged. In addition, trading is also done. What are the risk-reward implications of these three policies? This policy entails low risk and low reward. This policy entails high risk and low reward. This policy entails high risk and high reward. Obviously, this is a suboptimal policy. The firm may have to choose between this or this. What is the role of treasury function? Under 100% hedging, treasury function is a pure housekeeping function. It is a cost center. Under 0% hedging, treasury function is redundant. Under selective hedging and trading, treasury function is treated as a profit center, and transfer pricing becomes very important because operating divisions are given a price which reflects the forward price, and the treasury department is treated as an operating profit center. Management of operating exposure. Transaction exposure is short-term in nature and well identified. Operating exposure, on the other hand, is long-term in nature and can scarcely be identified with precision. So the instruments of financial hedging, forwards, options, and so on, which are helpful in hedging short-term, well-defined transaction exposures, are not of much help in hedging operating exposure. Managing operating exposure calls for designing the firm's marketing, production, financing strategy to protect the firm's earning power in the wake of exchange rate fluctuations. The important levers for managing operating exposure are product strategy, pricing strategy, plant location, sourcing, product cycle, liability structure. Firms are subject to a variety of strategic risks. The seven major classes of strategic risk are shown here. Industry margin squeeze due to greater competitive intensity. Industry margins may shrink. Technology shift. The emergence of a new technology may cast shadow over the future of the firm. Brand erosion. However powerful a brand may be, it may erode over a period of time. One of a kind competitor, a new competitor with a new business design may disrupt an industry. Customer priorities shift, customer priorities and preferences tend to shift over a period of time. New project failure, how well conceived and formulated a project may be, it is subject to a number of risks. Market stagnation, after a while, markets tend to stagnate. Let us examine the key strategic risks and the response that is appropriate for these risks. Industry margin squeeze. Pharma industry has been experiencing diminishing R&D productivity. Semiconductor industry has been experiencing rising capex. Airlines have undergone deregulation. All these have led to industry margin squeeze. The appropriate response to industry margin squeeze is to shift the compete collaborate ratio. Most companies do too little and too late. The notable exception is Airbus Consortium. Technology risk. Abrupt shift in technology can hurt an industry. Digital imaging shrank the market for film-based photography. The appropriate response to technology shift is double betting. Microsoft took a bet on OS2 as well as Windows operating system. Similarly, like Intel took a bet on RISC and CISC chip architectures. Motorola failed to pursue analog and digital cellular phone technologies and suffered grievously. One of a kind competitor, Walmart threatened the other players by its unique business model. In the wake of such a risk, one must change business design to minimize strategic overlap with the unique competitor, while others succumbed to Walmart. Target modified its business design to capture some slices of the market. New project failure, more often than not, new business projects flounder. An appropriate response to such possibilities of project failure is to smartly sequence the project and use the stepping stone method. Operational risk can be mitigated by having well-documented standard operating procedures, sound internal audit system, effective whistleblower policy, and vigilant check over corporate frauds. A great example of operational risk management is Morgan Stanley. 2,700 employees of Morgan Stanley worked in the World Trade Center, occupying 22 floors of the South Tower. On 9/11/2001, when the first plane hit the North Tower at 8:46 a.m., Morgan Stanley began its evacuation exercise at 8:47 a.m. When the second plane hit the South Tower 15 minutes later, Morgan Stanley offices were largely emptied. They suffered only 7 casualties. Soon after the 1993 attack on the World Trade Center, senior management recognized vulnerability. They initiated a program for preparedness under the leadership of their Vice President Security, Mr. Rescorla. He came from military background and he instituted a fire drill. On that fateful morning, Rescorla used bullhorn to tell employees to stay calm and follow the well-practiced drill. Sadly, he didn't survive. Morgan Stanley had prepared itself for a very tough reality. It had not just one but 3 recovery sites where employees could congregate and resume work. Business firms are subject to a wide range of legal and compliance requirements. Legal and compliance risk has increased over a period of time. No wonder corporate boards spend a very substantial part of time looking into various compliance issues. Companies which have a sound legal and compliance risk management program develop elaborate checklists for various regulations and create a strong compliance culture. Here are the 7 key guidelines for risk management. 1. Align risk management with corporate strategy. Risk management should subserve corporate strategy. Risk management should facilitate value creation strategies. We have seen in the case of MEC that risk management is used to promote value creating strategy, to proactively manage uncertainties. We live in a very unpredictable world, so companies should learn to proactively anticipate risk and manage them rather than react to risk as and when they arise. 3. Employ a mix of real and financial methods. Firms use real methods such as diversification, strategic alliance, and so on. And they also use financial methods like forwards, futures, swaps, and options. A judicious combination of real and financial methods is often advisable. 4. Know the limits of risk management tools. It is easy to get carried away by exotic risk management tools. One must know the limitations of these tools and use the tools very, very carefully. 5. Don't put undue pressure on corporate treasuries to generate profits. It is quite tempting at times to regard corporate treasury as a very important source of profits for the firm. If such a pressure is put on corporate treasuries, they are likely to speculate in a reckless manner. 6. Properly document the risk management strategy. It is imperative that a firm spells out its risk management policy and documents it. It enables the firm to respond to risk in a reflective manner, not a reflexive manner. 7. Reduce vulnerability. Firms should enhance their financial strength. Firms should build financial resilience in order to become less vulnerable to external shocks. Many companies where treasuries have resorted to speculation under an expectation to produce profits have suffered grievous losses. Here are some examples. Metallgesellschaft, a German metals and oil trading company, suffered a loss of about $1.3 billion from oil futures. Showa Shell, a Japanese company, incurred a loss of $1.5 billion from foreign exchange futures. Barings Brothers, a hoary British bank, collapsed when a rogue trader in its Singapore office took huge positions in the Nikkei index futures and incurred a loss of $1.4 billion. Here are some important lessons. 1. Senior managers should regularly monitor the risk associated with the derivatives position taken by the firm. 2. The firm should speculate on derivatives only when it has a comparative advantage in doing so. 3. A properly articulated policy for managing financial risk is an integral part of a firm's internal control system. Remember the principle that the less we articulate our expectations, the more likely are we to be disappointed. An important guideline in risk management is to spread risk ownership throughout the company by giving its operating managers the information and incentives to choose the optimal trade-off between risk and return. A company improves its ability to execute its strategic plan. Those who are close to operating risk are generally more qualified to handle them, so decisions to manage operating risk may be entrusted to line managers who can rely on their knowledge of the business, supplemented by technical advice where necessary. Bill Gates is a strong believer in spreading ownership of risk by empowering people with information on the intranet. Gates explains, a company's middle managers and line employees, not just its high-level executives, need to see data. Companies should spend less time protecting financial data from employees and more time teaching them to analyze and act on it. The last point, namely reduce vulnerability, requires emphasis. Thanks to the internet and globalization, the world has become a complex system comprising of a tangled web of interdependent factors. In such a complex environment, black swan events have become more common. In the words of Nassim Taleb, a black swan has three attributes. 1. It is an outlier as it lies outside the realm of regular expectations. 2. It carries an extreme impact. 3. The human nature makes us concoct explanations for its occurrence after the fact, making it explainable and predictable. These events make forecasting a futile exercise. So instead of trying to anticipate low probability, high impact events, we should make ourselves less vulnerable to them. An organization has to develop enormous financial resilience to cope with such black swan events. As Nassim Taleb says, I stick my neck out and make a claim against many of our habits of thought that our world is dominated by the extreme, the unknown, and the very improbable. Improbable according to our current knowledge, and all the while we spend our time engaged in small talk, focusing on the known and the repeated. This implies the need to use the extreme event as a starting point and not treat it as an exception to be pushed under the rug. I also make the bolder and more annoying claim that in spite of our progress and the growth of knowledge, or perhaps because of such progress and growth, the future will be increasingly less predictable, while both human nature and social science seem to conspire to hide the idea from us. Risk management has important behavioral dimensions. Risk management is all about managing ourselves, managing our ego, our arrogance, our stubbornness, our mistakes. It is not about fancy quantitative techniques, but about making good decisions in the face of uncertainty, scanty information, and competing demands. We find a very interesting transformation in corporate control. In the era of railroads, manufacturing dominated. When conglomeration became fashionable, marketing emerged as an important force. When raising finance became the biggest concern, finance assumed a central role. In the present era, where risks are multiplying, risk professionals have acquired a great stature. In a very insightful book titled Against Gods, The Story of Risk, Peter Bernstein, perhaps the most eminent financial historian of our time, argues that our view about risk depends on the temper of time. He looked at how humans have viewed risk in the long history of mankind. Before the arrival of Christianity, people felt that they had no control over the future and chance explained every outcome. In this environment, oracles and priests thrived. With the arrival of Christianity, random chance was out and God's will prevailed. From mid 1550s, the spirit of Renaissance flowered, and during that period, scientific spirit blossomed, theory of probability was developed, and the world seemed fairly predictable. After World War I, a world that seemed predictable turned out to be unpredictable, and this uncertainty prevailed till the end of the Second World War, when things started stabilizing and normalizing. From 1950s onwards, optimism prevailed, and during this environment, classical capital ideas were developed. If you look at major classical capital ideas such as modern portfolio theory, capital asset pricing model, efficient market hypothesis, and option pricing model, they all were developed during this period of optimism from 1950s to 1980s. In late 1990s, it appeared that dark and hidden forces were dawning on this world, and this feeling continues even today. In the last 20 years, we have seen several crises, particularly the global financial crisis and the COVID-19 crisis, which appear as black swan events, and the world seems to appear more unpredictable. John Kay and Mervyn King have written a fascinating book called The Radical Uncertainty, in which they argue that we seem to be living at a time of radical uncertainty. A perusal of top 10 risks by likelihood and impact for the last 5 years shows that most risks are social, geopolitical, and environmental. This contrasts with risks 15 to 20 years back when financial risks were considered to be major risks. Most companies are not geared to assess and manage risks of this kind. It's worth looking at what is happening to risk management in India. One, post 2008 crisis, a greater focus on risk management has been accorded in corporate decision making. Two, the major risks on corporate radar are currency risk, operational risk, credit risk, reputation risk, strategic risk, interest rate risk, and commodity risk. 3. There is a growing realization that a structured approach involving probable scenarios is far more desirable than reliance on market gurus. 4. Dedicated treasury teams have been created for centralized risk management. These are regarded as profit centers. As an offshore, transfer pricing has become very important. 5. In the wake of derivatives crisis, huge losses were incurred by companies which took positions in exotic derivatives and welcomed a no upfront premium associated with derivatives. Now the primary reliance is on simple forward contracts. The secondary reliance is on plain vanilla option contracts. 6. Thanks to mark-to-market accounting, treasuries have begun to realize the importance of accounting impact. 7. Leading companies are now using value at risk, cash flow at risk, and Monte Carlo simulation. 8. Commodity risk management has been somewhat neglected. However, its importance is now being gradually realized. Infosys has been a pioneer in risk management in India. It first articulated its risk management policy in late 1990s. The elements of that policy were: 1. No single vertical should account for more than 25% of revenues. 2. No single client should account for more than 10% of revenues. 3. The company should become more geographically diversified. 4. The company should be a zero debt company. 5. At least 40% of assets must be in liquid form. 6. The proportion of variable compensation should increase. Over a period of time, Infosys has developed a comprehensive and integrated approach to risk management called the Enterprise Risk Management, or ERM. ERM at Infosys encompasses identification, assessment, monitoring, and mitigation of various risks associated with business. ERM at Infosys seeks to minimize adverse impact on business objectives and sustain and enhance the long-term competitive advantage of the company. ERM at Infosys is integral to its business model, described as predictable, sustainable, profitable, and de-risked, or PSPD model. The approach to risk management has changed significantly in the last few decades, particularly in leading companies. Earlier, risk management was done in a piecemeal manner. Now, risk management is done in a holistic manner. Earlier, risk management was the concern of few executives. Now, risk management is a concern of all managers of the firm. Earlier, the thrust of risk management was on smoothing of income. Now, the thrust of risk management is on sustaining value creating strategies. Earlier, risk management was done in a somewhat ad hoc manner. Now, risk management is being done in a structured and systematic manner. Earlier, hedging against known risk was the emphasis of risk management. Now, the thrust of risk management is to diminish vulnerability against unknown risks. We have covered a vast terrain. It is time to summarize. The wide array of risks that a business firm is exposed to may be classified into several categories: technological risks, economic risks, financial risks, performance risks, legal and statutory risks, people risks, geopolitical risks, and environmental risks. The uncertainties of doing business have increased since the early 1990s thanks to globalization, advances in technology, deregulation, and so on. In the wake of these developments, the risk management perspective in progressive companies is shifting from a fragmented, ad hoc, and narrow approach to an integrated, continuous, and broad approach. The key steps in integrated risk management are identify risk, measure risk, develop a risk response strategy, integrate risk, and institute a risk infrastructure. Basically, a firm can do three things with risk: risk reduction, risk retention, and risk transfer. A firm can modify its operations in various ways to mitigate risk. In addition, it can also change its financial structure. The principle of comparative advantage is a very important principle in risk management. Forwards, futures, swaps, and options are important financial tools of risk management. In coping with the complex problems of managing corporate risk, the following guidelines should be borne in mind. A. Manage risk in an integrated manner. B. Align risk management with corporate strategy. C. Employ a mix of real and financial methods. D. Spread risk ownership throughout the company. And E. Reduce vulnerability. The four key takeaways for discussion are: 1. Risk management should subserve value creation. 2. The principle of comparative advantage should guide a firm about the risk to be borne and the risk to be transferred. 3. An integrated approach to risk management should be developed. 4. Reduction of vulnerability has become very important given the radical uncertainty of our times. Here are some of the books that you may like to read. Fooled by Randomness by Nassim Nicholas Taleb. The Black Swan, again by Nassim Nicholas Taleb. And Fundamentals of Risk Management by Paul Hopkin. Thank you.